Jeremy Goodrich here, your host for the channel, and this episode is going to be great. My guest is Sandhya Seshadri. She is a real estate investor, specifically in multifamily. She is invested as a passive investor in 17 deals. So she's involved in syndication. She's the passive investor, and there's another group of general partners or operators that are actually doing the deal. And now she's also investing as a general partner. So she's the one doing the deal and bringing capital in, other people's money, into the deal so that she can purchase a property, an apartment complex or what have you, and move that project forward. She puts together the business plan, does all the work with other partners that she has in her general partnerships to operate actual deals. And this video is going to break down, I asked her to break down the 5 most important steps to passively investing in multifamily. She is an expert in this space. She is all over social media. If you haven't followed her on Clubhouse or LinkedIn or Facebook or wherever, you definitely should. She's such a knowledgeable person and so much insight in how to not only invest as a passive investor, but also potentially collect money from passive investors to do your deal. So no matter what side you are on, this video is absolutely for you. You'll come out on the other side of this short conversation with so much more knowledge on exactly how to go on this journey in real estate. So without any further ado, my conversation with Sandhya Seshadri. So Sandhya, if somebody's sitting here listening going, okay, all right, I get why you're investing in that asset class. That makes a lot of sense. And I really want to invest passively as well. I don't want to deal with tenants, toilets, and trash. And I have another full-time job. I like what I'm doing. I'm building wealth there. I just want to diversify. And I would love it if we could put it in 5 steps, but like, what are 5 steps that person listening right now who hears from you and says, I want to do that. What are the 5 steps they can take to succeed in passively investing in apartments?
The first step would be to be very clear about your financial goals. So to say that I need my $100,000 investment today to produce X amount in cash flow, or in 5 years, I want to double my investment money, or whatever other financial goal you have, to be very clear about it. And to remember that any real estate investment in multifamily is going to be not liquid, meaning you will not have access to those funds for anywhere from 3 to 5 years. So, and every investment is different, but you need to make sure you have 6 months of living expenses saved in case of a downturn or job loss, etc. And then set your financial goals clearly and then look into multifamily. That's the first step. The second step in that same big picture. Yeah, sure.
Can I ask you on that first step before you go on to number 2? So like clarity and financial goals, that makes a lot of sense. If we use that $100,000 investment and use a 5-year timeline, and if this is just totally baloney, tell me, Sandhya, but is there a ballpark span of normal amount you can affect that $100,000 over the course of 5 years? Or is it just so far all over the place that you really can't even break it down to that simple?
So when I invest passively, one of the targets I have for myself is that in 5 years, my money, 100K invested today, as a round figure example, should give me a total return of anywhere from 80 to 100% within 5 years. So 100K invested today should become 180 or 200K in 5 years. And that includes all the distributions they make throughout that 5-year cycle. So the cash flow, as well as the final appreciation of the property at the time of sale, is included in that figure. But you should roughly make 80 to 100K on a 100K investment today within a 5-year span.
Okay. I love that. And I'm sorry for interrupting you. All right.
Perfect.
So what was number 2?
The second one is your overall goals and strategy. Like, let's say you're in a busy job today, you love it, you have no intention of quitting it, and you want to stay that way forever. But on the side, instead of putting all your money into the stock market, you want some of it in real estate, right? That's one strategy. Another one is, I know people who want to quit their day jobs or stop doing whatever is their current business. And so they want to start by passively investing in apartments now, and then eventually learn the business and start owning their own apartments. So what is your goal through this passive investment? Is it to learn the business so you can do your own, or just to have this lovely cash flow coming to you as mailbox money so that in 5 years you can quit your job, you can retire on the beach if you want, and never have to worry about a thing because this passive cash flow is going to be plenty for you. So, depending on that goal,
Mm-hmm.
choose where and how you want to invest.
I love that. So it's like the number one was clarity of financial goals. And number two is basically like clarity of life goals, what it is that
Mhm.
you're trying to do here, right?
Right.
I love it. Okay, cool. I don't have any questions on that one. What's number
Okay.
three?
So now that you've decided to invest passively, it makes sense for you. If your only goal is to get a lifetime cash flow and never go invest in, run a property yourself and be a permanent passive, as I call it, vet your sponsorship team very, very carefully in both cases. But in this case, sort of find some sponsorship team with a strong track record in a market that is going to be cash flowing with the movement of people and jobs towards there rather than away. So, what we call red states is a very important thing to note. They're more landlord friendly states. Everyone from the West Coast and East Coast are moving to certain geographic regions now. We're in 2021. They're all moving to Texas,
Mm-hmm.
maybe Arizona, Carolinas, Atlanta, Georgia is another place. Tennessee is another place that's seeing a lot of movement,
Yeah.
parts of Florida. So you want to go where the money and the people are going and the jobs are going. So make sure it's in a good market, but vet your sponsorship team. That is the number one way for you to make sure your money is in a safe place. Look at their track record, make sure they're transparent about it. And what you see on social media may not be the true story. So dig deeper.
What is step 4 in the 5 steps to passively investing in multifamily?
The market is very important. So you want to make sure, like I mentioned a little bit earlier, that it's a market that has job growth, diversity of jobs. So you don't want to be invested in an apartment that's in a military base with no other jobs around it, because when that base closes, you're kind of stuck. So you want to have diversity of jobs. And some of the things I look for is, medical, military, education, manufacturing, um, schools, colleges, those kind of things. You want to make sure there's different variety of employers in that area so that you minimize your risk. You want to make sure the job and population growth for that area is really high. Market is one of the most important things in analyzing a deal. So even though you might think, New York or San Francisco are great cities and highly populated, they're also extremely tenant friendly. And it's virtually impossible for you to evict a tenant in those cities.
Mm-hmm.
So you want to pick landlord friendly states. You want to make sure your sponsor is very well aware of eviction laws and rulings in that little county, in those local courts, because you might have pockets where the judges are more friendly towards the tenant and the landlord, and you want to be fair.
Okay. So we were around market
Mhm.
and knowing the market. And I think we really got into knowing the operator and the deal. It almost went back to vetting that operator and
Mhm.
seeing how they handle tenants and
Yeah.
relationships. So the last step that we have in passively investing in multifamily, Sandhya, what is that number 5?
It's your financials itself of the deal. So, what are all the metrics that matter to you? Do you need
Mhm.
a cash flow? Is cash on cash important? Is appreciation more important? Because, like a lot of my passive deals, I invested with my retirement money that I had rolled over from my previous job. So, I didn't care if I wasn't getting enough cash flow the next 5 years because I wasn't planning to take that money out. So, for me, appreciation was fine as long as the underwriting was conservative, right? So
Mhm.
that's something that I look for financially is the underwriting conservative?
So I'm going to go back through the 5 steps to passively investing in multifamily. Sandy, I think this is great. So number 1 was clarify your financial goals. What are you trying to do here? What's the point of investing in real estate and what are your hopes for the outcomes? Number 2 is what are your life goals and strategies? How do you think you're going to go forward with this? Is this going to be passive side income while you continue forward with your regular job? Or are you hoping to leap at some point from the job you have right now into doing this in a more active way? Number three, which we not only stayed on for a long time, but then came back to it over and over again, and I think there's a reason for that, is vetting your sponsors. There is maybe no more important thing in investing passively than vetting the people that you are about to get in a relationship with a large chunk of your money for 3 to 5 of the next years. That's number three. Number four is know the market. Again, if you're vetting your sponsors, you're probably going to hear a lot about the market as you're vetting them because they're going to be talking about that market. But is that a market that you feel is valuable? Is it diverse when it comes to jobs and is population growth looking good? Are people moving towards it instead of moving away from it? And then finally, the financials of the deal. This is you underwriting, and everybody has a different way of doing this. Some passive investors want to underwrite the deal just as in depth as the actual people buying the property. Others want to see sort of higher up numbers, but ultimately you've got to understand whether you want a cash flowing property that will give you money back over the course of that time, more streamlined, or appreciation where you may not get any money for a while, but you're more likely to get a larger chunk on the back end. Did I get it all?
That's pretty much it, and validate every number. So have the sponsors justify every number that they present to you with actual quotes from third-party companies like property management, insurance, taxes, etc.
Hey, Jeremy here. Thanks so much for watching this video. I hope you enjoyed it. I hope it created some clarity for you and zoomed you in on what action steps you actually need to take to succeed in real estate. If you haven't done so already, please head over to reiclarity.com and download our 9 action step framework. I believe that every real estate investor needs to take these 9 steps to succeed at the financial freedom they want to create for themselves. So if you haven't downloaded that already, please head over and get that at reiclarity.com. All right, until the next time, have a wonderful day.